I want you to imagine something now. You're a retail investor. It's 2021. You're watching CNBC, and a man in a sharp suit with a very confident glasses and a kind of cool haircut, let's be honest, looks directly into the camera and says, "This is the best buying opportunity of your lifetime." So you buy in. Then the markets drop 30%. You hold on. He comes back. Same suit, same glasses. This is the best buying opportunity of your lifetime. So here's my question to you. At what point does all this bullish stop being analysis and start being something else entirely? Tom Lee is back, and this time he says we're about to witness the best 2 years in market history. Best 2 years ever. Don't believe me? Well, listen to this, and we're going to break it all down, and I think this is going to change the way that you look at Tom Lee. I think it's important to note. Let's do it. Here we go.
My next guest sees more records ahead as one big catalyst may be getting ready to mobilize, which is retail. I thought retail investors already were mobilized. FundStrat's head of research, Tom Lee, is here.
He's a bit of a thing with retail investors today. Me and you.
Well, I think that investors got very cautious into the buildup of the war, and they were getting cautious because many stocks held by retail were getting hit. You know, the software stocks, and as that fell, we know there were record inflows into software, and of course the Mag 7 had been falling. So I think investors viewed the war and the start of the war as a time to take risk off the table, which was very different than what we saw a year ago when investors were buying into the tariff lows. And now I think that the downside tail risks have been removed for the war. Hedge funds have been early and they've been adding risk, and that we can confirm that from talking to our clients. And I think now it's retail investors that are now beginning to take money off the sidelines and buy stocks.
Maybe this is a psychological or a political question. I'm just curious if you have any insight as to why they would react differently to the Iran war versus not just tariffs, but anything else politically that's happened. I mean, buy the dips has become a well-known catchphrase. So it's surprising that they were kind of going the other way this time.
Not this one.
It is surprising. I was quite surprised because I would have assumed if someone asked me in 2026, a war is going to start, what will retail do? I would assume that they'd buy the dip. But in our surveys with our clients, we found that many maybe had policy puzzlement. You know, they didn't really know how big this war could become. You know, their biggest fear was gasoline spiking and we could get a recession or a depression, and a lot of economists warned of that. So I think it was difficult for investors to say, we can trust what the administration's doing, because there were too many people warning about the tail risks of that.
Is it possible they're right? You know, I was in a store earlier today and the radio was on. I haven't heard the radio in a long time. And the DJ it was some kind of pop or kind of broad station. And he was saying, you know, another check on gasoline prices, and boy, aren't they high? And I thought, wow, that's the first time I've heard gasoline prices talked about in a non-business news context.
This is how disconnected CNBC is.
Is it possible that actually there is going to be a bigger impact here and the retail investors actually know that and maybe the pros are missing it?
I mean, anything's definitely possible. One thing that we were at FundStrat were emphasizing is that inflation adjusted, even gasoline prices here aren't nearly the burden they were 5 years ago, 10 years ago, even at the 2008 peak. And the war is stimulating the economy, and we can see that in the earnings estimates and the ISM and even the jobs report. So I think the state of the consumer is one thing versus maybe how they might hear in a radio commercial or the surveys, but I do think the consumer is in better shape. So I think the retail investor will end up chasing this stock rally.
And you think as they do, that will power it higher?
Yes, but for the right fundamental reasons, because earnings estimates are higher. The U.S.'s relative position has really been strengthened by what's been exposed by supply chains through this war. And I think as the world investor looks for growth and they worry about growth in general, they're going to buy the U.S. stock market, which is a growth index.
We're going to talk in just a moment about international and whether, you know, you should, not that you have to choose, you can do both, but if you had to pick U.S. versus international, is it U.S.?
I'd still be overweighting U.S. because I think if you think about where innovation comes from, whether it's in tech, healthcare, or financial services or fintech, that's really U.S. companies. And I think there was an argument the U.S. PE should derate, but the war has exposed that the U.S. multiple should be going up.
Really? So that could be accounting. We could get both earnings and multiple expansion this year?
Yes, I think once we're through, this is still going to be a very tricky year because we have a new Fed chair coming in the market. It's going to test that Fed chair. But once we get through that subsequent turbulence, we are probably entering, an 18 to 24-month period that might be one of the best we've ever seen in our life.
Okay, so let's break all this down for you and let's see what you make of it. Best 2 years ever. Now, I have enormous respect for anyone willing to put a stake in the ground. Publicly, I do it all the time. It takes guts, I understand that. Most analysts hide behind vague language, precisely so they're never wrong. But Tom Lee doesn't hide. Tom Lee commits. And that's exactly why today I'm going to hold him accountable. Here's what I've done. This is what I've put together for you for a special event. This is live, unedited, unscripted, as it happens. We don't edit videos, we make them live. This is a live event. You've got the clock on the screen, you know what's going on. Please tap the like button, share this out, and consider subscribing to the channel. All this production is all done by me on my own, without AI, real and live. I've pulled together 10 facts, not opinions, not vibes, not feelings, but facts that every investor needs to hear before they act on predictions like this. So, fact 1 through to 9 are going to open your eyes, but fact 10 is the one the financial media industry does not want discussed. Now, I know I have first-hand experience at this. I've done interviews for Bloomberg TV and been pulled by Virgin Galactic dragging their tails. Let me tell you, the hair, the glasses, it's all production. The soft-spoken, mad scientist looking down, looking friendly to the retail investor. Everyone loves Tom Lee. Is he any use, though? Does he help you? So this will reframe everything, every prediction, every bull call, every best opportunity of your lifetime. So stay for fact 10, because seriously, this is going to make a lot of difference to you. Have you all tapped the like button? Have you all shared this out? All right, let's go, Mr. Tom Lee. Fact 1, the perma bull problem. Fact 1, Tom Lee is always bullish. I don't mean usually. I don't mean mostly. I mean always. Market up, bullish. Market down, even more bullish. Market sideways, great consolidation. About to break out. If the Titanic had hit the iceberg and Tom Lee was on the bridge, he would have turned to the passengers and said, beautiful entry point into life jackets. I kid you not. Here's the thing about being permanently bullish. You will eventually be right. Markets do go up over time. That's not insight. That's just time. The question is, it's not never, it's if. If it's always when, and when is everything, because investors don't live in eventuality. They live in mortgages, school fees, retirement accounts. They need to actually be there at retirement. Being always right in theory while being consistently early in practice is just another word for wrong. If you all tap the like button so far, please do share this out. This is live, unedited, unscripted. A lot of research goes into these events for you. No one makes videos like we do here on Martyn Lucas Investor. Fact 2, the Bitcoin target. How many times? Fact 2, the Bitcoin price targets. Let me take you on a little tour. $100,000 Bitcoin. Called it. $200,000 Bitcoin. Called it. $500,000 Bitcoin. Called it. Now, Bitcoin did hit 100,000 eventually. But here is what I want you to think about, and this is important, right? If I told you it's going to rain sometime in the next decade, and then 3 years later it rained, am I a meteorologist? Or am I just patient? There's a version of prediction making you throw out a bold number, wait long enough, and then clip the moment it happens for your highlight reel. The investors who acted on those calls at the time they were made. Many of them watched their portfolios collapse 70, 80% before the prediction eventually came true. Prediction without timing isn't investment advice, it's astrology, and with a Bloomberg terminal. Let's remember, folks, I make predictions all the time, and every single one has happened. My predictions are right. If I say I'm wrong, I say I'm wrong. If I say the markets are looking bearish, I say they're bearish. I don't just go, it's always going up, and you know, that's why 98% of my live viewers are members. If you want to follow my trades 24/7, I provide one-on-one support. I don't hide behind a TV screen. I'm live with you every day on Discord. There's my Discord, 90% discount, always 90% discount. And you get all my trades 24/7. I share it all with you. If my audience would like to fact check me now in the chat, say yes, is that true? Do I do all that? Do I share all my trades? Are they all accurate? Have I hit the target on every one? Let's move on to fact number 3, the Ethereum badge. Oh, I love this one. The Ethereum badge. Fact 3, let's talk Ethereum. And I like Ethereum. I have some. Notice anything? ETF badge right there, front and center, every appearance. Now, I want to be very careful here because I'm not making accusations. I'm just asking you to notice something. When someone is consistently, relentlessly bullish on a specific asset and they happen to be visibly associated with products tied to the specific asset, at some point, you have to ask yourself, is the bullishness driving the badge or is the badge driving the bullishness? That's not a conspiracy theory. That's just basic logic. Follow the incentives always and actually hold that thought on incentives because we're going to come back to that one in a very big way on fact number 10. You'll like that one. All right, fact number 4. Let's break it down. The presentation is the product. The presentation is the product. The glasses, the hair, the measured authoritative tone. I want to say something that sounds obvious, but apparently isn't. Now, remember, I've worked in theatre and production all my life, and I've even done interviews for Bloomberg TV. It's all a production. Trust me, it is. Confidence is not accuracy. The most confident voice in the room is very often just the loudest. The empty vessel makes the most noise, not the wisest. Tom Lee has a masterclass in presenting certainty. He certainly does. The slight pause before a big number. The slight pause before a big number. The slow nod. The I've seen this before energy. It works. It's compelling. It makes you want to believe him. And that is precisely why you need to be on guard. Because our brains are wired to trust confident people. It's a feature. It helped us survive as a species. It's amazing, right? When you put all this together, isn't it? But in financial media, that same wiring is a vulnerability. The best performing fund managers you've never heard of speak in probabilities and caveats. The ones you see on TV every week speak in certainties. Think about why that might be as we move on to fact number 5. Have you all tapped the like button? I hope you have. Have you considered subscribing? Thank you very much indeed. I make all these events live. Please do get involved. Fact 5. It's always now. It's always now. The urgency never changes. It is always now. Now is the breakout. Now is the inflection point. Now is the generational buying opportunity. 2 years ago, now. Last year, now. This year, now. I want you to think about what always now actually means logically. If every single moment is the defining moment, none of them are. Real market cycles are periods where the honest answer is it's not the time. Be patient, hold cash, wait. Those periods exist. They're real. They're important, but you will almost never hear that on financial TV. Now, when I talk about holding cash, I talk about going into treasury bills. I talk about it a lot. When the market is overbought, we go into treasury bills, SGov. Never cash, always in the market, but we don't just think the market is going up forever. We sold, remember, at the top of the S&P. We sold at the top of XRP and Bitcoin. And I bought on the way down, posted losses. Now I bank for free. You've seen me do it over and over again. If you want my Discord, there it is. It's only a couple of bucks a month. It will never go up in price, ever. No inflation, ever. No coupon code expiring tomorrow, ever. It's always 90% discount. Everyone can afford it. That's why everybody does it. That's why 98% of our live viewers are members. We have the highest engagement rate of anywhere in the world. In fact, a few moments ago, a news channel that was covering the Fed investigation with what Sensei was covering, with 1 million subscribers at 120 views. We had 250 watching us. Yahoo Finance, with 1 million, 2 million subscribers, they had, I think, 280. And CNBC had 3,000 views. Just goes to show the world is changing and we are leading it. We're not following it. So what you hear on television is utter nonsense. And I want you to think about why, because we're still building to something. Fact 10 is going to blow your mind. All right. I've been working in TV all my life. Fact number 6, macro. What macro? There's always a macro condition. Well, there are, but not the way Tom Lee puts it. Fact number 6, the macro blind spot. Interest rates rising, bullish. Inflation running hot, bullish. You get the idea. Maybe you want to join along, sing along, put your hands in the air and comment in the chat. You know what word's coming next? Liquidity tightening, still bullish. Global recession signals flashing, once in a decade opportunity. At this point, I'm fairly convinced that if gravity reversed direction and everyone floated off the planet, the headline would be stocks set to rocket. Higher on gravity news. But here's the real issue. Markets are complex systems. I've spoke about it a lot. It's easy to make money, the hard part's to keep it. Too many people don't understand the complexities of it all. They respond to real-world conditions, interest rates, employment, global capital flows, geopolitical risk. An analyst who is structurally incapable of being bearish cannot accurately incorporate negative signals. It would be like hiring a doctor who only ever says you're fine. Comfortable? Yes. Useful? Absolutely not. Do you like this so far? All right, fact number 7, the art of being early. Fact number 7, the retroactive reframe. This one is subtle. I want you to think about this one a little bit. Watch for it. And when a prediction doesn't land on schedule, it doesn't get retracted. Oh no, it gets adjusted. That wasn't wrong. It was early. The thesis is intact. The timing shifted. This is just a pause before the real move. Early is the financial world's version of, I meant to do that, but I didn't. Here's the truth. There is no prediction framework in existence that cannot be retroactively defended as early, which means it can never truly be falsified. And a prediction that can never be proven wrong isn't really a prediction at all. It's a story. Fact number 8. If you all tap the like button, a lot of work goes into these live streams. I love to rehearse to get it all right. All the production, it's just me in the studio. There's no one else here. No one makes videos like this. It's all done live, and I hope you're enjoying it. We're trying to bring you the best information that's helpful, useful, provide you with real service. Please do join us. If you'd like all my trades 24/7, there's Discord and there is YouTube membership. And don't forget, if you do a super chat during the show, it will be read out on the screen as well. No one gets left behind. Fact number 8. Who actually gets hurt with all this nonsense? Little spoiler alert. It's not CNBC. It's not Tom Lee either. But who is it? So someone always gets hurt. Fact 8. And this is where it stops being abstract. When Tom Lee goes on CNBC and says best 2 years ever, you just heard him say it, the people watching that aren't hedge fund managers. They're not institutional traders with risk departments and stop losses. They're people like your parents, your friend, who started investing in 2021, like all of my Lucasades, my Discordians. Well, not quite, because I'm here for them. Because everything's going up. The 58-year-old who moved their pension into crypto because a man with confident glasses told them it was going to 500,000. We got a special guest. Let's read this out. Here we go. Let's read this out live on the show.
At Diesel_Ada tipped $1.99 through Super Chat. Tom Lee is as loony as a $2 bill.
Absolutely. Fafo is right. Those people, when retail investors hear best opportunity ever, they do predictable things. With his little badge, making money, they buy late, after the hype has already driven prices up. They chase, moving into high-risk positions than they should. They hold too long because they were told it was going higher. And when it corrects, the man in the confident glasses with the funky hairstyle is already on to the next bull call. The retail investor is sitting with a portfolio that looks very different from the promise. That asymmetry matters. The person making the call risks almost nothing. The person following the call risks everything. So here we are. Fact number 9. If you all tap the like button, I hope so. Have you considered subscribing? Have you joined me on Discord? Because straight after this, I'm doing a Discord event. I'll onboard you all and do a live show answering all your questions and showing you all my trades. Been a very busy day today. I've been busy buying lots of things. Nothing that Tom Lee has told me to buy, just so you know. So, fact number 9. The numbers. The numbers don't lie. Let's look at the actual scorecard. Oh dear, Tom Lee won't want to watch this. Not the greatest hits, the full record. Bold prediction targets called years before they hit, if they hit. Stock market calls described as explosive breakouts that move sideways or down for 18 months. Asset class predictions tied to macroeconomic conditions that then flipped entirely. The narrative sounds incredible. The track record is complicated. Now, in fairness, nobody gets it right every time. Well, apart from me. I mean, not being funny, have I missed on a single trade in the last 3 years? No. Have I beaten the market? Yes. Do I consistently beat Berkshire Hathaway? Yes. Do I get it right more than Tom Lee? Oh, yeah. And that's not even hard to do. Not any analyst alive has ever got it all right, apart from me. But there is a difference between an analyst who is right 60% of the time and clear about their uncertainty and an analyst who projects 100% certainty and quietly revises when wrong. One of those people is being straight with you. Think about which one you'd rather take investment advice from. Okay? Fact number 10. The thing they don't want you to understand. Fact number 10. Everything I've told you up to now, the perma-bull problem, the mistiming, the retroactive rewrites, all of it points to one root cause, and it's not stupidity. Tom Lee's very smart. He knows a lot more than me. A lot richer than me. Not more powerful than me. Got better hair than me. Right? It's not even dishonesty, necessarily. It's incentives. Here is the question I need you to sit with. Who benefits when you believe markets are about to go to the moon? Asset managers. They're the ones who benefit because you keep your money invested with them. ETF providers benefit because you buy their products. Financial media benefits because bull narratives get clicks, views, and ad revenue. Anchors and analysts benefit because bullish guests get invited back. Trust me, I know. I've done this so many times. Nobody in that ecosystem profits from you sitting on cash. Nobody gets paid when you wait. Nobody benefits when you slow down and think. The entire machine, the TV appearances, the confident predictions, the best years ever, headlines, it's all optimized to keep you active, invested, and consuming. I'm not telling you Tom Lee is a fraud. I genuinely don't believe that. I'm telling you that he operates inside a system that has very specific incentives. And those incentives point in one direction. Always up. Always now. Always buy. That system is not designed around your financial well-being. It is designed around engagement. And if you don't understand that, your distinction, you will eventually pay for it. So folks, I'm going to come to the end now. I'm going to go over to my Discord. I'm going to provide one-on-one service. I'm going to answer all your questions. I'm going to help people out. I'm going to show you all my trades 24/7, always live, always accountable, always real. Want to be part of it? I've never lost on a trade. There is my Discord. There is my YouTube membership. Maybe you'll come and join me. One-on-one discussions, 90% off, a couple of bucks a month. I don't make any money from it. Time you take out the deductions, the tax. It is what it is. I just want to help people. So let's wrap up with my final thoughts. I hope this was of some help to you. This isn't a takedown video. I'm not having a go at Tom Lee. I think he's great. It's great entertainment. Really clever guy. Knows history. Knows more about analysis than I'll ever know. But it's as useless as chewing bubblegum while trying to solve an algebra equation. None of the predictions are right. They just keep kicking it down the can. It's pointless. I genuinely don't enjoy going after individuals. I don't. I love everybody. I'm Mr. Nice Guy, really. I call everybody stupid. I like to have a laugh. But at the end of the day, you know, I'm just here for entertainment. That's not the point. The point is this. One question, every prediction, every single one, including mine. 2, before you act on any market, call, ask who benefits if you believe it. 3, the best financial decisions you'll ever make will probably feel boring. I've been buying Coca-Cola all day. Everyone's going, what? Really? You're buying Coca-Cola again? Well, yeah, because this morning the market rallied. Why did it rally? For no apparent reason. Apparently because we got a deal now in the Middle East. They've been selling off. That makes sense. Well, what not? It does in a way. Buy the cannons, sell the trumpets. We had the rally, now everyone's dumping it. But the reality is we don't know if the war's over. Might carry on. What have I been doing? I've been doing this. I've been buying Coca-Cola. And I'm up on it now from where I bought it. People are going, oh, you don't want to buy that. It's boring. Doesn't make any money. Well, I've gone from $5,000 in my portfolio all the way. This is my real wealth tracker. Here it comes on the screen. This is my real money, all my money. There we go. Started with $5,000. We are now at 683. No options. No shorts. Coca-Cola, the S&P. No crypto either to do that. In fact, I'm down on crypto. Now, the reason why it says only 9% up all time, because I only added the wealth tracker like a few weeks ago, right? But I started with $5,000 4 years ago. So I've done all right, haven't I? Do you not agree? I think I've done pretty well. Anyway, so there you go. It might feel like boring buying Coca-Cola, buying the S&P, but it works. Just focus on value. Don't focus on the rock and roll. They won't come. They never come from a man in a sharp suit on cable TV. No, they don't. So next time someone tells you, special guest on the stage, just wait a second, let's read this.
At Diesel_Ada tipped $1.99 through Super Chat. It's like trying to say toy boat 3 times fast.
Toy boat, toy boat, toy boat. Oh yeah, I'll give you that. Best 2 years ever, he just said. Just ask one question, based on what? Based on what? And then wait for the answer, because it's good. If it's good, they'll have one. Did he have one? No. There is no answer because the economy isn't booming at the moment. The stock market until a couple of weeks ago was down on the year. Not a great start. let's be honest. Inflation still isn't all the way down. It's still sticky. Rates are still high. We're not going to cut rates. I said we wouldn't cut rates this year, and we're not going to cut rates this year. We've got unpredictability. We've got still tariffs coming through. We've got a war going on. That's getting worse. That could be the worst oil crisis in history. Recession is still a real potential. And yet, best 2 years ever. Well, it can be if you focus on value and not listen to Tom Lee. So join me in a few moments. I'll be on Discord. I'll be there in about 20 minutes. Come and join me. I hope you enjoyed this. It was fun making it. I hope you all enjoyed it. I'm now going to let you go, and I'll see you back on the next one. That's it from me. Thank you very much for tuning in. I hope you share this video out to your friends, and I hope you always win, because remember, it's easy to make money. The hard part is to keep it. And we're always winning here on Martyn Lucas Investor. Until next time, as always, take care of yourselves and each other. Bye-bye.